Well, good morning, ladies and gentlemen. Welcome back to day 2 of the conference. We've got the hardcore in here this morning, early, bright and early. I'm sure everyone is on their way. This is the usual format on day 2, to be honest. Give it 2 minutes and everyone will be in here. But we're going to kick straight off here. No time to lose. We're going to start off with our analyst keynote presentation, China Metals and Mining Outlook 2018. We've got a real expert for you this morning to tell you about that topic. He's from Shanghai Metals Markets, Singapore. He runs the office down there, but he has a long track record with Rio Tinto, CLSA and Macquarie as a commodities analyst and strategist. Delighted to welcome Ian Roper. So, Ian, please.
Okay, well, thanks very much for all those of you who turned up nice and early this morning. We'll start off with look at the top-down macro side of things. So my view kind of into Chinese New Year since the start of the year is very much that China would be inverse to the world. Macro-wise, China has always been inverse to the world. If the global economy is weak, China worries about the export-driven slowdown and they stimulate domestic demand. Equally, if the global economy is strong, that's when they tend to pull back a bit on stimulus, hold back some of the firepower for when they need it later, and counter the stronger growth from the export-driven sector. So that's very much the message that we saw China pushing, certainly in Davos. A very strong speech there by Liu He, saying the export engine is very strong and we're going to slow domestically, and you will be surprised how much we do, was the actual line that he used. So I think that's why we saw a bit of disappointment in metal prices coming out of Chinese New Year. Basically, expectations were just a bit too high. So certainly we saw that in steel, where physical traders were really bullish going into Chinese New Year. Global economy is strong. China looks pretty strong. For the last 2 years, if I've held steel inventory going into Chinese New Year, I've done very well out of it. So that's why we saw everyone was kind of quite long on the physical markets. Then coming out of Chinese New Year, we actually saw a little bit of credit tightening. That caught everyone off guard. So expectations probably a bit high after Chinese New Year, but equally I'd say the sell-off that we saw out of Chinese New Year was probably a bit too aggressive. So I still think 2Q looks very solid. So everything that we're seeing, I was up in China a couple of weeks ago, everyone was saying, look, orders to traders, a little bit softer, people complaining about credit issues, but orders to end users are fine. Order books across steel mills, smelters across the board, order books are very solid. Our steel PMI comes through very strongly for March. The steel inventory is drawing bang in line with seasonal trends. So we're quite happy. Underlying demand is still there. The wobble that we've seen after Chinese New Year is nothing to really be too concerned about. And very much still think 2Q will be a good demand season. So right now, I think steel will be the main beneficiary of that. Obviously, the base metals have had all this LME, Russia, US influence over their pricing recently, whereas the steel is very much just a physical domestic China story. And I think that'll be quite strong over the next couple of months. But the key thing is, China is marginally slowing the economy. The two methods they're using to do that, number one, mild credit tightening, but very targeted, so not broad-based. And the other thing is slowing infrastructure spending. That's been a clear message as well. So start of the year, they cut the rail spending budget from 800 billion RMB down to 700 billion. And there's been a clear messaging that they are going to slow infrastructure projects this year. Now, on the trip that I did a couple of weeks ago, we couldn't really find anyone who'd seen any cancelled projects. So I don't think the slowdown in infrastructure will hit demand too much this year, but it's probably a headwind going into the end of the year next year when these round of projects are finished. They're going to do less going forward. Now, we have seen this clamp down on the PPP projects. I'm not sure how widespread that's going to be. But I've been saying all this stuff about China slowing down. Equally, what we've seen with all the trade war speculation means perhaps they are going to not slow so aggressively. I mean, I've been very impressed with this administration so far. They're very good at micromanaging and changing direction to, suit the situation. Now, the previous administration, Wen administration, was very broad brush. It's stimulating, everything's on, we're tightening, everything's off. These guys are very good at micromanaging. So I'm not too worried that China would over-tighten with the backdrop of potential trade frictions, I think that's meant that they've stepped back a little bit from the tightening. But equally, the macro numbers we saw in March were pretty robust. So I think certainly we'll be on a very mild downward trend this year on the demand side of things. So 2Q very strong, second half we certainly fade. Obviously another big question mark is over housing. Housing, obviously the kind of backbone of commodity consumption, especially in steel. Some scary numbers on the housing side. I mean, you've seen a huge jump up in activity last 2 years. Now, very much pressure remains on sales. Sales will clearly be negative this year, mid-high single digit. But the construction activity will probably fare slightly better. Developers bought a lot of land last year. Balance sheets for the developers are very strong after all these sales. So construction activity probably only a mild single-digit decline. Now, the big concern for housing structurally is that the central government last year actually spent 1.8 trillion RMB buying 6 million apartments and just giving them away. That's their destocking policy. They call it shanty house redevelopment. They're not really shanty houses. They're basically giving away new apartments to people who are living somewhere that's maybe 15 or 20 years old. It's a pretty good upgrade system, really. But this is really holding up the property construction activity. So the central government was kind of a quarter of housing sales last year, 6 million units the government spent. This year they were going to wind that down to 5 million units, but they got cold feet on that. They've raised it to 5.8 million because they're not a bit worried about the slowdown. So this is a 5-year plan, but it's very front-loaded. They should be winding that back. On the other side, though, they're ramping up the new policy on the rental housing. Now, this is kind of the smart thing that Xi realizes about housing. He said in the Congress last year, housing is for living, not for investment. So they're basically saying we can never control the private market, right? And there's no way we can bring that down because the ownership rates are so high. So for people who can't afford the crazy overvalued private market, I will build them myself and just rent them out cheaply. So young people can still move to the big cities, live their dreams. We'll just provide them with cheap rental housing. So 30% of all new land development in Beijing and Shanghai, they're the pilot projects, 30% of land in those cities is going to go to this government rental housing, and that's going to be expanded through the country later. So the government's still going to be building an awful lot. So structurally, you have to be worried about the housing market. China's demographic profile is horrendous. The ownership ratio in urban areas is 1.2 units for every one family. Technically, they could stop building today. They don't need any more apartments, especially with the demographics. But the government is going to keep supporting this because they know the economy can't live without it. So yeah, lots of structural headwinds, but I think demand for this year, like I say, 2Q is going to be very strong. Everything that we're seeing says demand is fine. You've obviously had all the construction activity across North China with the winter restrictions has been restricted for 4 months. That's going to come, it is coming in now. So yeah, 2Q very strong, mild fade in demand through the second half of the year, but still some structural headwinds to consider further forward. So if we just run through the individual commodities, iron ore, now that's a fun one to follow. In the old days as an analyst, you used to do a supply-demand model and it would give you some indication of where the market's going to be. That's been a complete waste of time for the last 18 months. So we just rip up the models and throw them out. Iron ore is clearly very well supplied. We think 80 million ton oversupply last year. Domestic mines, there are over 2,000 domestic mines in China. We speak to over 300 of them regularly. So we say Chinese domestic iron ore production was up about 12% last year, 258 million tons. And the imports are up 55 million tons. But pig iron output on our numbers, adjusting for the induction furnace closures, not the CISA numbers, our numbers said pig iron output was flat last year, even down slightly. So iron ore was oversupplied by 80 million tons, and yet the price was really, really strong. So why is that? The key thing on iron ore is Chinese steel mills, right? Chinese steel mills are not profit maximizers. That is the key thing, right? 60% of Chinese steel production comes from SOEs. If you're the SOE CEO, you have your objective list from the government, from SASAC. Number one, make money, pay lots of taxes, pay the workers, pay down some debt. But I'm exceeding that objective by such a large margin, right? I've got no one breathing down my neck saying you need to make more money. We're making so much money, I'm under no pressure at all. My other objectives, minimize the emissions, maximize the productivity. Now that's what I'm under pressure for. If I screw that one up, I get fired. So as a CEO of the steel mill, I'm telling the procurement department, we're making all this money, spend whatever it takes to buy me the best quality raw materials because we have to minimize those emissions. So that's why they are paying through the nose for pellets and high-grade ore and not considering buying the low-grade stuff. And that's why FMG is now selling low-grade iron ore to India, the home of low-grade iron ore, because Indian steel mills are profit maximizers. They're sitting there looking at the VIU saying, yeah, if I buy low-grade, I'll make more profit. I'll cut the productivity, I'll increase the emissions, but I'll make more profit, and that's my number one target. So that's why the low-grade ore is looking at ex-China markets, and Chinese steel mills will just not consider it at all, not while they're making excess margins. So yeah, iron ore horribly oversupplied, port inventory extremely high, 160 million tons, but the mills will continue to pay very high prices for the high-grade iron ore while steel prices and margins remain high. So like I say, 2Q, I think steel prices will rally further. They've bounced rather after the fall we've seen post-Chinese New Year over the next quarter, and I think iron ore will get carried with that. So yeah, there's no shortage of iron ore supply today, but the price can still do well for a few more months, and you're not going to see that high-grade, low-grade spread narrow until Chinese steel margins really come under pressure. So the question then is on what's going to happen on the, like I said, steel demand doing pretty well. Inventory, yes, it was slightly higher year on year, but it's still drawing in line with the seasonal norms, kind of 5 weeks after Chinese New Year, starting to turn and now accelerating further. Our steel PMI March reading was actually ahead of where it was last March. It's, I think demand's perfectly reasonable. So yeah, the key question on Chinese steel, will margins be sustainable at these high levels? Now I think as domestic demand does soften through the second half into next year, margins will come down a bit. But the key question now is what's next on supply side reform? Right, so we've closed so much steel capacity in China now. Utilization rates are extremely high. That's why the margins are very good. Now, the winter cuts were phenomenally successful. The air up in Tangshan was actually cleaner than Singapore for half of December. It's been a miraculous success story. So the government's saying, what next? We don't want to just close this stuff 4 months a year. Let's actually move it. So that's the new capacity replacement policy we've seen since January. So 1.25 to 1 replacement ratio in environmentally sensitive areas, 1 to 1 replacement ratio elsewhere. And this has triggered a huge volume of new steel mills to be built, and especially biased to EAFs. The government's really pushing the EAF scrap story, and this is what I've always called the rusty nail in the coffin for the iron ore industry. Right, China has consumed over 10 billion tons of steel in the last 20 years. Now, if you look at Japan, Korea, and Taiwan, they started to generate the scrap 15 years later. They got about 25 to 33% of the steel came back as scrap. So China was a 100 million ton a year steel consumer in 2000. It's now a 650 million ton a year steel consumer. That S-curve we saw in steel consumption is starting to be replicated as an S-curve in the scrap generation. And the government sees this. And obviously EAF steel mills, much cleaner than blast furnaces at the plant level. You don't have sintering, you don't have coke ovens. So the government's really pushing the build out of EAFs. We have 48 million tons of them under construction right now. So these are all replacement. There's no net capacity gain, but certainly China is swinging from blast furnaces towards EAFs. Scrap consumption last year was 170 million tons, but about half of that actually came from fresh scrap, offcuts at the steel mill and consumer. Only half of that is obsolete, but the obsolete scrap is now growing 8-10 million tons a year, and that will only increase from here. So structurally, the iron ore pricing doing very well now off the back of steel, but Chinese steel demand has clearly peaked and plateauing at best, probably comes off a couple of % a year given the headwinds with housing and infrastructure going forward. And the growth in scrap consumption in China means iron ore demand is going to be in permanent decline kind of from here onwards. So the iron ore industry is probably the worst of the commodities at this stage. There's very little. It doesn't have the ex-China story that other commodities have. So India has an abundance of domestic iron ore, as does Africa, a lot of other ASEAN countries as well. So you won't see the growth in import demand that can offset the decline in Chinese iron ore consumption. So yeah, iron ore will continue to do well for a while yet, but structurally looks very, very difficult. Moving on to the base metals. Aluminium, so these slides are all the Rusal stuff, but just looking at the China domestic market, aluminium, the whole Western world was very positive on aluminium in the new year. I think people got the wrong end of the stick on supply side reform. Supply side reform in steel was real, right? They eliminated outdated capacity, utilization rates are much higher, the profitability is there. It's been a real change for the industry. Aluminium supply side reform was all about strengthening Chalco and eliminating or hurting Hongqiao and Xinfa, the private guys who were just throwing in endless low-cost capacity through the downturn, forcing Chalco to cut. But that all concluded in November last year, right? Hongqiao got bailed out by CITIC. It's now a quasi-SOE. It's back in the fold, and that's why they got the massive discount on the winter cuts. So the winter cuts for Ali were supposed to be over 2.5 million tons. They ended up being less than 1 million tons. Instead of drawing inventory through winter, inventory went to record highs, 2.2 million tons of aluminium, and we still haven't really started drawing that. We were drawing that last few weeks, and then last week, aluminium inventory in China has gone up again. So aluminium is still very well supplied. We've seen plenty of closures, yes, but China is still building a lot of new smelters. There's about 4 million tons of new smelters switching on this year. They've all got licenses because they've bought them off Chalco. So there's no shortage structurally of aluminium in China. So that's why we think the price of Ali will remain on the cost curve, and the cost curve is falling, right? We've got the anode prices coming off post-winter. Coal finally coming down. The big issue with coal last year was hydro. The underperformance of hydro added 100 million tons of thermal coal demand in China, and that's what helped to support the coal price. But the government's been pushing the supply to respond. They've kept the mines working through New Year. That added about 50 million tons of supply. And coal prices have now fallen from 720 RMB pre-Chinese New Year to 580 RMB, approaching that government target range. And that's why we're now seeing a clampdown on coal imports again. So I think government's finally got coal under control, but hydro is certainly the key thing to watch for the coal prices. And then the key thing, alumina as well. So if you look back at the, so for aluminium, this is a couple of weeks old. We cut 1 million tons of aluminium capacity over winter. Only 0.3 million tons had restarted at the end of March. But for alumina, we cut 4.5 million tons, and nearly 4 million tons of that switched back on because the alumina margins are very, very attractive. Now, with the Rusal stuff, we've already seen a few exports from China, but they are re-exports of imports which hadn't cleared customs. They just reloaded them straight on the ship and sent them out again. We reckon China could get alumina exports up to 100,000 tons a month reasonably quickly, given the kind of $300 price spread. Now, it looks like there was more news out of the US last night that may soften the prices if they're going to ease up and the aggression on some of the sanctions. But yeah, fundamentally, it looks like alumina is being a bit better supported, and that will give the cost support to aluminium short term. Fundamentally, with the Rusal stuff, if the sanctions do continue to happen, I think ultimately China can buy all the Russian material. The Russians will just sell it into China at a discount. China has no problem dealing with the sanctions. If you remember with Iran, through the Iranian sanctions, Iran was China's 4th largest supplier of iron ore. That was no issue at all. China can operate outside the US dollar banking system. So I could see all the Russian aluminium going into China, but we'd have to see a structural spread of LME over Shanghai to account for the 15% export tax to get Shanghai ingot into LME warehouses. So I think that's how Russian sanctions basically mean we'll have to see more Chinese aluminium exports to balance the ex-China market. So I think we'll see a structural spread now. Shanghai Chinese aluminium market will remain oversupplied. It will price off the Chinese cost curve. Today it's about 14,500 RMB, but once alumina sorts itself out, probably comes down to 13,500. And then we'll see a structural spread of LME prices over Shanghai to get the exports out with the 15% export tax. So yeah, that's the aluminium story. On the copper side of things, looks pretty balanced here. I mean, when you look at the copper market from different angles, you get kind of different stories. So copper on the concentrate market looks extremely tight today. Right? The Chinese were trying to sound relaxed for the annual negotiations. As soon as the price was settled at 82.25, the spot price went to $75, and it's continued tightening after that. China's adding 1.2 million tons of smelter capacity this year, and they're worried where they're going to secure the concentrate. So the cons market looks really tight, even though perhaps some of that disruption that was expected on the seaborne supply is not coming through in terms of strikes and things. But still, the concentrate market looks pretty tight. On the other hand, you look at refined copper. We didn't see much of an inventory draw last year. Inventory has actually gone up quite strongly, about 300,000 tons globally over the first quarter. A lot of that's seasonal, though. It is starting to come down now. Physical premiums, pretty neutral on copper here. But one thing I think the market got a bit wrong is the copper scrap story. Right? A lot of people are like, great, Category 7 import ban, we're going to lose 300,000 tons of copper scrap supply in China. Look, that's not happening. Right? The margin on the copper scrap is too high. You're not going to lose the supply is just getting processed elsewhere. So you're seeing the Chinese are diverting the Category 7 copper into Cambodia, Vietnam, Philippines. The reason China banned the imports of Category 7 is it's very dirty stuff, right? To get copper out of a motherboard or wiring where it's wrapped in rubber or plastic, the way they process it, they basically pile it up and set fire to it. All the rubber and plastic burns off, and you're just left with the copper. So yeah, China's decided that's too dirty for China, but you can do that elsewhere. So they're just diverting it. So the copper scrap will ultimately get into China. It'll just be processed outside of China. So we think some of the bullishness around the scrap story probably a bit overdone. So yeah, overall for copper looks pretty neutral this year. A bit more supply growth coming through. We've got a slight deficit for this year. But yeah, overall, I'd say copper at current prices, pretty neutral. Still the best structural story by far, of course. Do subscribe to the view that the global mine supply is just not going to grow fast enough next few years. A lot of mines going backwards. And copper, to me, is probably the number one beneficiary on the EV side of things, because copper already has a great demand story with the leverage to the consumer. That's not just China, it's the global emerging middle classes buying more white goods and electronics. So you add on top of that the EV story with the rollout of the charging stations and cars and everything, then that copper demand supply looks very attractive next few years. So I'd say structurally copper is still very much the best of the metals. How are we doing timing wise? Are we oh yeah, 8 minutes, right? So on zinc side of things, zinc's very has looked extremely tight. We were drawing a lot of inventory. These charts a few weeks old, apologies, before the New Orleans delivery, but since then they've been coming down again. So the concern with zinc is that everyone knows there's about 1 million tons of cons coming on globally over the next 2 years, but it's biased to the end of this year and next year. So the concern was that we're drawing refined zinc so quickly. Could we get down to a level where big traders can play games and corner the market before the supply arrives? And you'll get a final kind of spike higher. Now, there's about 300,000 tons of zinc in bonded warehouses in China, kind of waiting to deliver into a final price spike. And it just doesn't seem that there's enough momentum to give us that kind of final spike higher. So the supply is arriving. But even if the zinc supply arrives, it's only taking us from an extremely tight market to a more balanced market. Right? We need that supply. The zinc TCs in China are extremely low. But zinc prices are already at demand-destructive levels. Right? For steel mills, complain galv steel is very much their lowest margin business. You're seeing zinc above $3,000 is certainly demand destructive for things like alloys. People are using other metals now. So we think zinc's probably on the last leg of its bullish story. The supply is coming. Prices will probably soften a little bit, but still sustainable in the high 2000s because it's still going to be a pretty balanced, slightly tight market. It's not like we're going into oversupply as we are in aluminium or nickel. So nickel's the one where I'm probably most different to the market. I think the market's horribly wrong on nickel. Ever since LME week last year was, all we heard was EVs, and then since then the nickel market's just completely disconnected, right? The LME nickel prices have tracked NPI costs in China for the last 8 years. And since November last year, they've gone off on their own direction. Everyone's obsessed with the EV story, right? You have to remember EVs only consume, or the entire battery market only consumes 60,000 tons of nickel. Nickel's a 2 million ton a year market. Stainless steel still takes 1.6 million tons of nickel. So in my mind, this disconnect, yes, it's a great structural story, the whole EV growth story. Don't get me wrong, still subscribe to that. But it's a story for the 2020s. Nickel prices should not be running off that story today. They're getting way too ahead of themselves. So we are seeing a massive supply response from NPI. Right, the margins in nickel pig iron today are huge, and the margins in stainless steel are negative. So nickel cannot sustain at this level. Right, you're seeing the stainless steel market in China suffering. They're cutting production, And you're seeing the MPI guys ramping production massively. I was up at the biggest MPI producer in China a couple of weeks ago. They have 24 furnaces, adding another 8. They make 100,000 tons a year of nickel pig iron, right? It's, you know, their margins are just huge. So we've got a 155,000 ton increase in MPI output, 77,000 in Indonesia, the rest in China this year. So there is no shortage of nickel units. Now, yes, when you look at the actual deliverable nickel, yeah, inventory is in a continuous downtrend. You can do a demand supply for the high-end deliverable primary nickel. It looks like it's a deficit story. But fundamentally, if the stainless steel guys are suffering, if there's a flood of MPI in Indonesia and China, which the stainless mills in China can then absorb more MPI, China will be buying less refined nickel. You'll see China's imports drop off. That'll free up more to be delivered into the LME. And then you should start to see that LME nickel inventory turn around. And then nickel will go, oh, hang on a second. There's actually too much of this stuff around. And nickel prices should go back to pricing off NPI. So the NPI production cost in Indonesia is about $7,000 to $8,000 a ton in nickel equivalent. Right? In China, it's about $11,000 to $12,000. Today, nickel is about $15,000. So you've got a fair bit of downside to nickel short term. So, I think nickel's the one that the market's got a bit too overexcited for this year. Now, the structural story for nickel is, do we reach a saturation point for MPI over the next couple of years? Because obviously for high-end stainless, you can't use MPI, right? If you're making stainless steel and pipes for oil and gas industry, you have to use high-grade stainless. So you do need refined nickel. You can't just make that entirely from MPI. So we reckon China's stainless market, you can probably saturate about 80% of the nickel supply from MPI. Today it's about 60%. So that would imply kind of the market would be capped out at about 900,000 tons of MPI, which we could get to kind of in the next 2 years. So if that happens, then maybe that's when you can see a bifurcation in the nickel market, where MPI is basically maxed out. You can't use any more MPI, and then MPI prices price off their own cost curve. Whereas then, as the battery growth continues, maybe that's when you can see nickel sulfate battery materials really start disconnecting. The feedback loop, of course, is that actually you just shut down Western world stainless steel, and China keeps adding more stainless and becomes a massive exporter of stainless. But obviously trade tensions and all that kind of stuff may limit that story. So yeah, at the moment, I think MPI is going to really hurt nickel this year. But structurally, we may reach to a point where we have too much MPI and just can't use it anymore. So yeah, that's all the kind of miserable stories, sorry, to depress everyone. EV side of things, we still like the EV story. I mean, lithium is, we've got a fair bit of supply around at the moment. China has no shortage on the spodumene side of things. There are a few processing bottlenecks in China, but they've added massive processing capacity over the last 6 months, especially things like lithium salt. So lithium looks a bit more comfortably oversupplied. We think prices have been a bit weaker. They'll probably stay that way in the near term, but still got great growth. Cobalt, very much the favorite. Now that's been ahead of our price forecast for this year already. The only risk to cobalt is there is about 30 to 40,000 tons of hidden inventory in China. A lot of funds have been playing the cobalt story for a few years. That's about 40% of annual supply already physically in warehouses, but they're not sellers at the moment. But if something spooked them into selling, that could give cobalt a bit of a shock. But certainly the structural story is still there. But when we look at EVs, they are very, very policy driven. We're very enthusiastic about the growth. I think China can certainly surprise to the upside on the EV side of things. Government's pushing it quite aggressively. But like I say, copper's my favorite. I mean, China's massively behind on the build out of the charging stations. They've only got about 400,000 charging stations for 1.7 million EVs. The rough rule of thumb should be about 2 to 1. So the state grid's fallen quite far behind building out the charging stations. So that's something that they should see a big acceleration in investment. That'll be very good for copper. So yeah, still bullish on the story. I just think that nickel has got the wrong end of the stick for now. It's run too far ahead of itself in the short term. But I'll finish there. Any questions from the floor?
Any questions? Yeah, Andrew.
Firstly, thanks for that. That was as masterly an exposition of metals outlook as I think I've ever seen in the time allocated. That's 35 years of watching people talk about metals. you correctly characterize the current Chinese administration's extremely skillful micromanagement, finessing of pluses, minuses, acceleration, deceleration. What are the vulnerabilities? How might that prove to be erroneous or an illusion? What are the risks in terms of an upset?
Sure. I think, well, I mean, the big thing that they did, the first couple of years when Xi came in, they tried Western world economics, right? Xi came in and said, right, let's have slower growth now and improve the structure of the economy. So they tried a deleveraging cycle. They tried opening up the RMB. And by second half of 15, that was just killing them, right? So they nearly died following kind of Western economics. So January 16, they said, we've got to change this, right? Let's go back to what we know best. We'll fix the RMB, we'll stop the outflows, and then we can just keep printing money and building stuff, right? And that's, you know, the China model that's worked since the early 2000s. So as long as the money can't leave China, they can just keep printing it and it sloshes around and goes into construction and infrastructure and just keep building stuff. So they've very much gone back to that model since 2016, and that works. So, you know, as long as they keep the RMB is the key swing factor for that. Now, obviously, the problem with the RMB being pegged to the dollar is they're stuck with the US interest rate cycle. So the last 3 Fed hikes we've seen, the next day, the PBOC's hiked 10 bips, 10 bips, 5 bips, the last 3 hikes. So my concern, the main risk for China next year, I think, from a macro perspective, is US inflation, that the Fed gets behind the curve, and then US, say, labor inflation really starts ripping, and then the US starts hiking aggressively, say, next year, and China is stuck with that. Now, obviously, they could just let the RMB depreciate more, but then that brings up the whole outflow cycle again, because as soon as people think it's depreciating, they run for the exits. So that's probably the number one risk, would be the US rate cycle and how China manages that. But at the moment, as I say, with the RMB fixed where it is, then, you know, the money can't leave, and I think they can just keep printing it and building it. It's all domestically held. So I'm not worried about this whole debt to GDP ratio. I mean, yeah, I've been following this for a long time. I was in China in the mid-2000s. Everyone comes over from the US or something, goes, this market makes no sense. Debt to GDP is too high. They're going to have a banking crisis. You know, it's just, we've been calling that for ages, yeah. I mean, China can't have a banking crisis like classic emerging markets because there's no short-term funding. It's just like one big bank. Unless every single person in China decides not to deposit their salary every month, you can't have a short-term funding crisis. So you can just get the slow kind of Japan-style misallocation of capital, too much debt, just it's a drag on growth. But I think China can just keep printing money for now, and, you know, we've still got a good few years left of the same model. But, you know, you look at the demographics are horrendous, right? They could literally stop building new apartments tomorrow and not have a problem. It's like, that's the biggest structural problem for China, but hopefully that's far enough in the future.
Okay, well, unfortunately, we have run out of time there, but that was a fantastic presentation there.
Thanks.
Can we have a big round of applause for our speaker?
Sure.